All right. Good morning, everyone, and welcome back to another episode of the Tim and Tim Show. Every Tuesday at 10 a.m. Eastern Time. If you haven't heard, you heard it again now because I say it at the beginning of every show. It's my little jingle, and it's muscle memory. And it's a way to let everybody know when we go live. Now, obviously, you can watch these shows later if you're watching on YouTube or our podcast. Appreciate everybody listening to these shows. And we got a fun topic this week. Tim Best texts me. He goes, "What are we talking about this week?" And I was like, "I don't know, Tim. What are we talking about this week?" And he goes, "Let's talk about if we would do it again, if we could go back in time and exercise that hindsight is 2020 muscle." This is always a fun conversation to have. Would we do some of those deals again? And we'll leave it there, and we'll get into the meat and potatoes of our mindset on the deals that we would and would not have done again and why. So with that, Tim, where you want to go with this?
I don't know. No, seriously. I I just kind of want to like revisit like some things that, we've done because, we've talked to before we even started the show today. Tim and I were talking about, somebody we know that is not doing this stuff anymore. And Tim, we've seen a lot of stuff coming out, lately about operators struggling, value add deals, you name it. And then today, I'll give a little credit here. Today I was doing my normal morning routine and saw a little post from a guy we all know, Bill Hamill. Bill, love your stuff, man. Keep doing it. And he was talking about a deal that he did, I don't know, like 4 years ago or something like that, and how he put it on stabilized debt and all this other stuff. And I'm reading it, and I'm like, boy, that sure sounds nice.
Yeah.
And I'm like, huh. And I want, and it made me think for a second, like, hey man, with debt at 6 and 7%, where it's been the last couple of years, and it's coming down a little bit, guys. I mean, I fully acknowledge that, but you know, that 4%, 3.5%, 4% debt for 5, 7 years, sure, really, really sounds sexy right now. But it wasn't like a few years ago, right? That was not the sexy thing. And so, Tim, I'm just kind of curious. Let's talk about this if you're cool with it. Like, if you could go back to 2020 and 2022, that 3 year span, would you still, knowing what you know today, would you still chase some of the value add deals that you did? Um, or would you go lock in on that 4% stabilized debt and sit on it for 5 to 7 years?
So I actually have this kind of a wrench in this whole conversation, right? Is
Go for
as
it.
much as the softball answer is, yeah, I want to lock in as much long-term debt as I possibly can, right? That's the softball. But conversely, what is going on in the headlines right now of all of the people that did lock in that low interest rate debt, and now they have to refinance 5 years later, and rates are double what they locked in at, and the property values aren't there to refinance, and they're having trouble taking out their debt.
Well, let me throw a wrench into that.
Oh no, you can't double wrench it.
I'm going to double wrench you right now. But are a lot of those folks people that locked in at low bridge rate debt, and they were assuming 3 and 4% refi debt, or is it truly people who locked in like 2022? No. Let's do real math here. 2021 on a 5 year stabilized, and they're refining, and let's just say best case they're getting 5 3/4, right?
Mm-hmm.
So they went from 4, and guys, we're playing high low here. So I'm giving you high on the 2022, 2021 debt, and I'm giving you a low on the 2026. So this is like best case scenario almost.
Yeah, best case, right?
Yeah. So because really you could get 3.5% back then too. So let's say you got 4, and today you're able to get 5 3/4 instead of 6 1/4. And are those people struggling? Maybe. Now I would also look at them and be like, but why? Because you've had 5 years to, even at $25, $50, $75 rent increases, you've had 5 years to do that.
That ideally, right, that somebody would come in and continue to do their value add over a longer period of time. They would have bought it at a great basis. But there are people out there that bought it way over leveraged, because they could get such a low rate,
There you
right?
go.
So you got an 80% loan at 4%, and you had this security blanket of low interest for 5 years. I can ride this out, and you weren't aggressive on your rent increases. You want to just keep it full. Well,
Yeah.
then, over the last 2 years, you had taxes reassessed and doubled, insurance doubled and tripled, utility usage rates doubled, payroll went up. If
Yeah.
they didn't increase the value substantially to offset the increase of those expenses, they could be in a really bad spot right now because they're looking at a cash-in refinance.
You know what's crazy? You know what is crazy, man? Is it all comes down. I'm going to say something knowing, and Tim knows this, knowing that I got an investor out there who is like pulling this cord on me left and right. It all comes down to operations, right?
Yeah,
Like
does.
whether you overpaid or underpaid or you bought right, it still comes down to operations, right? And because what you said right there is over the 5 year span, I'm going to say this really bluntly. Basically, you pissed away your 5 years, right? You didn't do the work you needed to do over the 5 years and took advantage of that low rate debt, right? You bought a stabilized asset that was spitting off some cash flow every month, and you said, cool.
Set it and forget it, and you forgot
Yeah.
it.
Yeah. So, to again, shout out to my man, Bill over there. Like that ain't what Bill does. Like I know Bill, and I mean, he and his team operate really, really well. And it all comes down to operations, right? Like whether you bought a value add deal, a heavy value add, or stabilized on really, really sweet fixed rate debt, you still got to operate it.
You still got to operate it. You still got to increase the income because expenses go up over time. And obviously, this is an extreme example, but hypothetically, it's possible that somebody, was, singing the tune of their low interest rate debt and that they're the best investor ever. But then they get to this refinance and, they can't get 80% leverage. They can only get 65.
Yeah.
The rate went up and the cash flow went down. I mean, there are definitely people out there that could be experiencing that. Now, you would hope that somebody is keeping up with market rate rent and continuing to increase and keeping expenses low and not just forgetting about the deal. But I don't think it's a softball answer that anybody that bought a property in 2020, 2021 with great low interest rate debt is in the best of positions right now to refinance their properties. I think it could be a smorgasbord of how much you actually cared about your property. And I'll say this is a broad stroke, but I would say that because we self-manage our properties, we get weekly updates of occupancy, collections, marketing materials, how many leases are we getting converted. We're on top of those everyday, day-to-day metrics of operating your deal, where there could be operators out there that bought it well, that got low interest rate debt, that put it with a third-party management company, and because it was spitting off cash flow and paying its pref, they didn't really care a whole lot, and they maybe only met with them once a month. And as long as it was doing what it was doing, no harm, no foul, right? Keep it full. I want that passive income, right?
Me too.
Yeah, me too, right? But I mean, would I do it again? It depends on the deal, right? Information is hindsight, and there are deals out there, one in particular that I would, three in particular that I absolutely would not have done again, knowing what I know now. And a lot of the problems have been with the city. So one of my red flags going forward is if I got to pull permits and deal with the city, I ain't doing it because it's going to double my timeline and double my budget.
Yeah. He's not wrong. And I'm not quite in that same boat, but I would double my timeline and double my budget.
Yes.
Because I know one of the ones you're thinking about, and at the time we had somebody working with us that they're like, I know I can do it for this, and well, it never got done for that, and this is one of those. And to be fair, there was the whole city component that nobody was factoring in on that piece. Nobody knew, right? But at the time, so let's be fair to the past, right? Because you would think that we're here like dogging on value add, and we're not, because we did them too. So let's be fair to the past for a second and talk about like going back in time a little bit. Do we remember what the case was for value add and why it made sense, right? And guys, here's the thing: like value add always makes sense. It does, right? it always makes sense no matter the time or the market or whatever. There's always a case for it, right? You just got to be very smart about it.
Yeah.
So, you know, back in 2019, 2020, 2021, 2022, when rates were so low, guess what else was really low? Bridge rate debt, right?
Mhm.
I mean, bridge rate debts, Tim, back then, I mean, they were like,
I remember the lowest bridge rate debt that I can think of was 5.75.
I was just about to say they were sub 6, man. And they were where stabilized is now, right?
It was the Alabama property was
Right.
5.75 with Lima One bridge
Yeah.
loan.
Yeah. And so, you know, you're looking at sub 6% bridge rate debt, you know, thinking you can, you know, hey man, that's stabilized debt's at 3.5, 4%. So maybe we refi into a 5.25, right? We're still going
Mhm.
down. We forced this appreciation. We've added this value. Our cash flow is higher. We're already cash flowing at 5.75. We're sure as hell going to flat cash flow at 5.25, right? And
Mhm.
so operational upside, forced appreciation, you know, rent growth, right? It was all there. It all made sense for
Everything was
value add
there.
deals.
Yep.
Yeah, everything was there. Um, and you know what was interesting is I had an investor challenge me recently, and they're like, "Man, value add just seems reckless." And I'm like,
Mm,
"It's only
no,
reckless if you
no.
go into it blind and uninformed, right?" Right.
Yeah, but you gotta think, I mean, you look at people flipping houses. There's people are always flipping houses, always. Up market, down market, doesn't really matter. People are always gonna be flipping houses because there's always gonna be a need to rejuvenate a property that's tired at the end of the
Yeah.
day. And
Yeah.
being able to execute on the deal is important, and obviously underwriting conservatively is super important. The problem is you get into this weird juxtaposition of what is the difference between underwriting conservatively and underwriting so that you are kind of thinking about every potential downfall that could even possibly happen. Like if
Mm.
you underwrite to that speculation of literally the world falling apart, you're never going to buy a deal, right? There's going to be some level
Yeah.
of risk in there that you're baking in that rates are going to go up or down, rents are going to go up or down, cap rates go up or down. You know, it's all a big kind of puzzle, right? Of is like, is it actually going to go our way or is it not? So let's try to underwrite it so that if it doesn't go our way, but you could never, I would say that nobody would ever underwrite to the wheels falling off, right? It's
No.
like, you know, you as an operator do everything that you possibly can to make sure that it doesn't happen, but there are always things that are out of your control. I mean, Alabama property, since we were talking about that one, we bought it. The insurance cost was $17,000 a year when we bought it. Okay. I budgeted $25,000 a year on the renewal because I was like, we know it's going to go up. It's coastal, blah, 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 blah. The renewal came in at $82,000.
Yeah. Yeah.
Nobody would ever underwrite to that. No one
Right.
in their right mind would. I mean, I increased it 25% over what it was, or 30% over what it was, which was very conservative at the time. You know, and it's like,
Yeah.
it's those types of things that you can't predict and that you can't judge. But at the time, to be fair, everything was there. We had, in place rents were $600. We're going to get the rents to over 1,000, which we have. The forced appreciation was there, but what you didn't account for was the taxes didn't really move a whole lot on that property, which are great, but the insurance quadrupled, and then the cap rate decompressed a whole bit, 1% or 100 basis points or over the course of a year. Like it got hit really hard, really fast, and that's what made that deal ultimately very difficult, which is unfortunate. But at the time of acquisition, it made sense. But what's the
Yeah.
lesson that you learned there? The lesson learned is that you have to take a risk, you have to try, and
Right.
if not every deal is going to work, not every deal is going to hit, not every deal is going to go your way. I mean, you and I can honestly sit here and say there have been some deals that have went our way fantastically, and
Oh
I
yeah.
love
For
those
sure.
deals. But
Yep.
the only way that I had the opportunity to participate in a deal like that is I had to take risks on other deals that I thought may be able to do something like that and get me a single or a double, right? So some were
Yeah.
home runs, some were singles or doubles, some are strikeouts. As long as you don't, lose your money, you're gonna strike out in the real estate industry at some point in time on one or more deals. But as long as you
Yeah.
don't lose money, you're doing all right.
Yeah, I want to go back to something you said because I think it's really, really important that people realize this because guys, like we teach underwriting and making moves, and by we I mean mostly Vitality here. Teaches underwriting and making moves, but at the end of the day, a lot of these guys teaching underwriting, they'll go in and they're like, hey, you got to expenses 5%, right? We increase expenses 5% year over year. Well, what he just said was, yeah, I had my 5% escalator in there, but down on the insurance line, that individual line, I bumped up 25%, right? Like, so, guys, like that is conservative. That is like highly conservative, especially compared to what other folks were doing, and at the end of the day, we talk about this. We go back and we look at our underwriting. We go back and look at like where
Always.
we were, where we are, and things like that. And guys, like a lot of it, we've been pretty spot on about. Like pat ourselves on the back. Go ahead, man. Give yourself a pat on the back. We've been pretty spot on with a lot of things. The one that the outliers consistently across the board for us has been that insurance line.
Yeah, and the cap rate decompression. I mean,
right.
I would decrease or expand the cap rate 10 basis points per year of ownership. But what we saw over the last 2 years was, 50% or 50 basis points or even 100 basis points. Like that would have equated to owning it for 10 years to see that level. Like it was unprecedented amount of change in the market in a very short period of time.
Yeah, and man, so to give yourself some credit here, like we have some properties that even with that, we're still at a very solid valuation with a lot of equity locked up in the deal, right? We still have that going on, even with that decompression, which says a couple of things, which says, hey, there's somewhere we did really well. And then there's somewhere else in there where we're overshooting what we were conservative on, right? Like we are outperforming our conservative assumptions. And Tim, I think one I'm thinking of right off the top of my head. I'm like, hey, on that property, we're crushing it everywhere, except right there, there, and that kills the day-to-day cash flow, right? It absolutely kills. But even in terms of value, we're still there with an increase in value, right? And at the end of the day, guys, like we all talk about how value add made sense or it didn't make sense. And would you have done it and would you not have done it? I think you hit on something that I didn't even plan on talking about. We came into this is the opportunity of doing those things that it brought, right? That it brought. And to your point, man, if you hadn't done some of those, if you hadn't taken those on, maybe these other things don't present themselves, right?
Absolutely don't, right? Because then you were never on base. You didn't build relationships with people. You didn't do transactions. You didn't build a reputation with brokers and investors. Like, again, some deals you strike out on, some deals are home runs, some deals are singles and doubles, right? I mean, you try to underwrite for consistent singles and doubles, but it happens. Like, what's the national average for batting averages in the MLB? Like 30% of the time you get on base or something?
Yeah, I think it's like you strike out, 2 out of 3 times that you step up to the plate, or you get out, not strike out, but you understand. You baseball like purists, you're going to call me out on that one. I know you are. But you guys get it. You don't get on base more often than you do, right?
Right.
And
making money's hard, but there's risk attached with it. And, you got to swing, you got to take a step at bat and you got to try it. And, we talk to ourselves about, the assumptions that we're putting on paper and what is reasonable, what's expected, what's our baseline numbers. And, do we think that this is possible? And obviously, as we continue to do more and more and more and more deals, we understand everything a little bit more, a little bit more, a little bit more. I think my underwriting's changed pretty significantly, right? Since, over the last 5 or 6 years, it's changed. It's, taking into account what we know and all the relationships that we built, like even, for example, relationships in the insurance industry, right? That's a hot button. And what are those insurance brokers seeing across the board with all of their clients? We have those conversations. I have those conversations of like, well, what are you starting to see in renewals this year? Are you seeing rates change, go up, go down? The feedback was property insurance was going down last year, but the general liability insurance was going up. Maybe that's true at our time of renewal in August. I'm kind of expecting a 10% increase on GL, but maybe another 10% decrease on property. That's still a win to me, right? Because the property is obviously more expensive than GL. But So you start to see your insurance costs come down, and it's changing the way that we're underwriting and putting what our growth numbers look like on paper, so that we try to be as accurate as possible, right? You pull up your underwriting file and you compare to where you are today versus where you thought you were going to be a couple of years ago. And there's some deals where, I like the ones where, recently we were looking at some takeout debt for two properties that we own, and I underwrote to a 5.8% takeout debt. And the two quotes that we got back were 5.7 and 5.9 at 75% LTV, and I underwrote to 70% LTV. I was like, hey, that works out.
Yeah.
Good job.
Yeah. And the nice thing about that, guys, is that one, it makes you feel good, makes you feel better. But then
Validating.
two, but then two, it makes you realize, like, hey, at the end of the day, not only am I not only am I underwriting correctly, and my valuations tend to be pretty spot on, if not at least within the acceptable margin of error. Then the other piece too is like, hey, operationally, because the one thing Tim and I haven't talked about is, like, hey, we mentioned we have a few that it's like, I don't know that I would do that one again, knowing what I know now, hindsight being what it is. But at the end of the day, we still have it. We're still operating it, and we're still moving it forward. And we have exits for all of it, right?
Mm-hmm.
We have reasonable exits planned for every bit of it. And notice, folks, I didn't say like we had exits planned that we're going to like hit those numbers that we told folks like 4 years ago, 5 years ago. We have reasonable exits planned, right? And that's a far cry different than like some of the things you mentioned earlier, where folks are just like, I'm done. I don't want to do this. This is hard. and
Yeah, right.
And I think I'm going to go buy a business now. Something like that. Whatever the like.
You thought real estate was hard. Wait till you start running a business. That's a new level of hard. What's funny? I actually had a conversation with my wife last night. I was like, I don't know what's harder, being a parent to a very young child or running a business. And I was like, they're both hard.
In some ways, they're very similar.
Very similar, but damn it, they're both hard. And going through both at the same time is even more hard.
You ever looked at your 2-year-old? I know I've looked at my 18-year-old, and I've been like, I don't even understand what you're thinking. Like, what was the thought process behind that? And sometimes I look across our company and I go, I don't know what these people are thinking. Like,
right.
And I'm like, it's so very similar sometimes.
Yeah. Oh, absolutely. But yeah, I mean, but back on track with the, would we do it again? I'm going to go out here on a limb and say yes, because at the time of the acquisition and what we knew, we were making good decisions, and we've learned a ton. Oh my God, we have learned a ton, and that is only going to set us up for future success. If we didn't have those experiences, we would not be able to be better stewards of our investors' money and gain the trust from our investors. I mean, there's a number of investors that are like, hey, look, I get it. Not every deal goes right. But you've done everything that you possibly could to make it go right. And I see the value and the hard work there. Now, that's not every single investor, but the majority, right? More than 50% of the investors that are investors themselves, they understand, kind of how that thing works. And that trust and that reputation goes a really long way. But now the conversations are going to be way different when we start acquiring deals again. It's going to say, well, because of my experience in XYZ situations, I'm underwriting to this level and I operate in this market already, and I know what these things are going to be. I feel way more confident about these numbers than ever before because of the information, the knowledge, and the experience that I have today, because of those, everything. Right. And you gotta kiss some frogs, man.
Man, you're becoming that guy, right? You're becoming that old operator that we used to look at and go, what's wrong with you? Why? And and he's like, I've seen this before.
Yeah.
You're becoming that guy, right? And I think that's good, right? I mean,
it is good. Yeah.
I mean, because here's one thing I will say. I saw 08 and 09. I've seen the last few years. And the one thing I can say is, man, people were hot and heavy in like 05, 6, 7, 8, right? And then they were hot and heavy in 19, 20, 21, 22. And there's a lot of people in both of those scenarios that got in. They're not here anymore. They've moved
Yeah,
on.
they're not here.
And and but here's the thing is the guys who like made it through, 20 years ago and are still here, they were smarter this time around.
Yeah.
And they're doing really, really well. And it's like, hey, that's experience, that's lessons learned. And I think the lesson learned, Tim, here is, would I do it again? Yeah. I mean, are there some properties that I may look at knowing what I know now and go, I don't know that I'm jumping into that, probably, but would I do a value add again? Absolutely.
Absolutely.
100%. Yeah,
There will definitely be more value add short-term bridge loans in our future, right? I mean,
for sure.
I just had a post from one of my mastermind groups where, the person runs a hard money lending company and they're like, we need to start doing some loans more than $1 million. Are
Yeah.
you commercial guys looking for some short-term? Well, yeah, if I can buy it cash and then refinance it in less than 6 months, I build that cost into my deal. And I know that, I got the team to operate it well and be able to execute. That's an option for me.
Yep.
Would I take on 5 of those at the same time? Absolutely not.
Yeah.
But I'll make sure that the one that we take on has everyone's full time and attention and
Yep.
speed of execution so that you can get to that point and turn it over and move on to the next one in a more quickly and much neater fashion.
Yeah, it's funny, man, guys. Like we didn't talk about this topic at all before we got on
Mhm.
today, but Tim and I are like 100% on the same page here, and that just tells you we've been through that foxhole together the whole time.
Oh
Because
gosh, yeah.
yeah, because he said exactly what I was thinking, which is like, hell yeah, I'll take it on again. I just won't take 5, 6, 7 of them on all at once, right? Give
Yep.
me give me 3 good stabilized deals and a really good value add, and let's go, right?
Yep.
And that's
Yep.
what we'll do, you know.
Definitely a
Um,
bit more of a balanced portfolio, but, it's
hun-
funny, the more I tell brokers about what our underwriting criteria is now, I still don't have any deals under contract. But the feedback is, "Oh, I've been looking for guys like you, stabilized buyers." Okay, send it to me,
Send
and
it
and
over,
everyone knows, hey, day 1, my investor's gotta make 7% cash flow, day 1.
right?
Not that hard. And everyone's like, "Yeah, yeah, yeah, I got tons of deals for you." No, they don't.
Well, and guys, I think that's one other thing we've learned too, right? I mean, we're talking about value add. I think we're investor sentiment. What investors tell you they want versus what they really want, right? And
Yes. Right.
everybody wants that. Like, I want to give you 25 grand and make it 50 in 2 years. Okay,
Me
cool.
too.
Like, I want to do that too. But then what you hear is, where's my distribution? Where's my distribution? It's
I
like,
haven't
oh,
gotten paid in 2 years. Well, you get all your payments on the end.
yeah, so what you really wanted was cash flow. Okay, that's
Yes.
different. So let's go
Yeah.
find some cash flow deals, right?
And
Um,
I've had a number of conversations with a lot of even my larger investors of like, they're like, I want to be in debt positions now. Perfect. I can do that for you. Right. But
I can
that
do
looks
that.
different.
Yeah, I can do that.
And
And
I think, we talked about this recently, right? On a couple of different shows. It's like the investor tolerance is a lot different than what they thought it actually was. Like
yeah,
their risk tolerance is way different than it actually
yeah,
is.
yeah,
And maybe
100%.
my risk tolerance is right where I thought it was. Risk
Yeah.
it for the biscuit. No.
Well, and some of that changes, right? Like,
Yeah.
guys, like in full disclosure, Tim and I have had conversations about like, hey, 5 years from now, 10 years from now, like, I think maybe I want a blend of debt positions and a value add deal, right? Like,
Mhm.
hey, I think I may go lend 2 million out at 10%, 12%, and then do that and have one value add deal going on that I'm looking to strike, a 2x over 2 years kind of thing going on.
Yeah.
Um,
Yeah,
yeah,
just definitely, the amount. I mean, the focus and the amount's gonna look different, but
yeah,
man, Dennis, yes, they do have pro forma deals for you. Well, no, sorry, day 1, the key word there, Dennis, is day 1. Day 1
yeah.
cash flow.
Yeah.
Um,
I'll take your pro forma, but it's still got to hit day one cash flow, right? Like,
correct, and this is what I'm willing to pay, and I've just gotten super picky and selective because I just don't need to go
yeah.
through what we've gone through the last 2 years. I don't need it again.
I
So
I think I think a nice way to say that is like I agree with your pro forma. We're just gonna have to back the price tag off a little bit because I still got to hit this day one.
yeah,
Like, I don't
correct,
disagree where it can go. I just need it
and
to be here
maybe I
now.
get there in the future, which is, hey, good for
Right.
me. I did all this work to get there, but it's gotta
Yeah.
be this day 1.
100%.
So
100%. So
this was a fun episode, fun topic, because hindsight's so easy to talk about, and like, we could say we're reminiscing, of past deals and mindsets and 4%, sub 4% interest rates. Ooh. So, all right, guys, that's all we got for today. Appreciate everyone joining. And if you, drop a comment in the Facebook group or YouTube, and do my best to answer everybody's questions and comments. Appreciate you all joining, and see you next Tuesday. Peace.
See you guys.